Welcome to Business Talk. Well, if you've been watching the markets this year, you'll know it's been a tale of, I would say, two emotions: relief and a lot of renewed optimism out there. Local and global equities have enjoyed an impressive run, certainly the kind that reminds us of the old market saying the rally always climbs a wall of worry and then sprints, because there was a lot of worry around Trump and Liberation Day, but look at where we're finishing. The thing is, when markets run hot, investors often face their most interesting decisions. Do you lean in? Do you diversify? Do you hedge? Do you take a bit off the table? To help us unpack that, I'm joined by Matthew Pouncett, who's co-portfolio manager at Laurium Capital. Matthew's been steering hedge fund strategies through good cycles and bad cycles, and I think everything in between. And today we're going to be looking at what's driving the current momentum and why hedge funds may deserve a seat at the table. And certainly as we look into the trends of next year, how that all fits in. So Matthew, it's great to have you with us. And it's an apt moment, isn't it, to take stock, no pun intended, because markets really they've had a remarkable tear. So let's just start right there. What do you see as the key forces behind this incredible run that we've seen in equity markets this year?
Thanks, Michael. And James said right, it has been a very, very strong year for equity markets. So if we look at our local market, we're up 38%, I think, as of this morning, which is quite a remarkable number. If you break that out, there's a couple of drivers. I mean, what's been very interesting about this year, so you've generally had a risk on global sentiment. You've had global central banks easing policy. You've had a weaker dollar, which is a huge influence on emerging market financial conditions. So that's helped. If you look at the SA bond market, which has rallied quite substantially, has really eased financial conditions and created risk on environment, which is generally good for emerging markets like ourselves. The big additional factor that we've seen this year, which has been very, very interesting, has been the run in the gold price. And why I say that's very interesting is that during a risk on market dynamic, the gold price is usually weak or not playing an influence at all. This year, it's had a substantial impact, especially on the JSE. So if you look at the gold mining companies, they're all up sort of 150% plus really year to date. And that's on the back of course, of a very, very strong gold price. But what's interesting about that gold price rally is that it's happened during this sort of risk on environment where typically gold rallies in a risk off environment. So that's added, if you like, fuel to the fire that's created this very strong market dynamic locally. And then there are some other elements, for example, the telcos have had a fantastic year. That's very much idiosyncratic. It was price increases in the rest of Africa. Elements like that, company-specific factors. The platinum shares have rallied a lot. That's also partly driven by the gold price that has, we think, to some degree pulled up platinum prices as well as a jewelry substitute. But that was, of course, coming off a low base in the prior year as well, but where platinum prices were struggling. So you have had this sort of confluence of factors, if you will, that have kind of all come together at the same period, which has created this very strong rally. And then offshore, the big theme has, of course, been the AI trend and the amount of capex that has created. And that capex obviously has fed through to economic growth as well as earnings upgrades for, if you will, the hardware players in that part of the market, which has created big earnings upgrades and therefore really supported the rally that you've seen in the US.
And I suppose one could debate specifically on that last point around AI capex, how sustainable that is, what kind of earnings they would have to produce to grow into and justify that level of capital expenditure and a lot of the circular financing that we've seen. But I think, without getting into those weeds, every seasoned investor learns that good times aren't just for celebrating. You look at a year like this that we've had and they're for calibrating now, what do you do next? And given these strong runs, I think some viewers might be thinking, well, why complicate things? Let's just ride the index out into the new year. But I think hedge funds do have a very interesting role during precisely these kinds of market phases. Why should investors consider allocating a portion of their capital to hedge funds, even when traditional markets are humming the way they are?
Oh, it's a great question. I mean, the real two factors that support the inclusion of hedge funds in your portfolio is that they offer diversification and risk management. So let's kind of break those up. I mean, the diversification one is a key one. So if you spoke about the index and do you just ride the index? The interesting thing about what's happened this year is that the composition of our local index especially has changed quite dramatically. So you've now got single commodity miners, golds and platinums, which are about a quarter of the index. Now, those type of shares are highly operating leveraged, often highly financially leveraged as well. And a small little downgrade in those commodity prices can create very, very steep drawdowns in those particular shares. So the index constituency right now is a fairly risky one in a sense because of this high concentration to single commodity miners. Now, hedge funds, we are absolute return driven. We're focusing on reducing drawdowns as well. So the composition, even of our long exposures, of the exposures where we are putting on risk, are going to differ markedly from that of the index because we're not chasing an index. And even a general equity manager is going to be very conscious of where the index is sitting because that's what they're chasing, that's what they're trying to perform against. So you'll even find your equity funds will have a large tilt towards these riskier parts of the market. A hedge fund is going to be absolute return driven, and our long exposures are going to look very, very different to that of the index. So a great diversification benefit. And then of course, there's this element of being able to short and to manage drawdowns and risk. And of course, when you've had a big run in the market and multiples locally aren't looking especially high, but they are overseas, and you run the risk of a drawdown, that ability to short and manage that is quite important. And then, what's really critical about a hedge fund and this idea that you have, long exposures and short exposures, the real benefit is that you're creating a unique source of return. Okay, so if you think of the spread profits that we earn on our long books outperforming our short books, that's unique to our fund, and it's not correlated with other return sources that are sitting in an investor's portfolio. So the real benefit of a hedge fund is your ability to diversify and to get differentiated sources of return. And if anything, that's more required after a very, very strong run in the market index, and especially when the composition of that index has changed to a more riskier inherent starting point, if you will.
I think it's a very compelling argument to be made for increasing one's allocation to hedge funds. And you often hear the wise old traders saying the best time to buy insurance is when no one really thinks they need it. And I kind of feel that we're in that kind of space in the market at the moment as well. Now, let's talk about what you've built at Laurium, because you've built out this well-diversified suite of hedge funds, I think each with its own kind of personality and risk budget, so to speak. So for a viewer watching today, could you just walk us through the funds that you run, how they differ, and who they're best suited for, especially in the context of today's market climate where growth and risk do feel unusually intertwined?
So, the interesting thing about hedge funds is that one fund can differ markedly from another. So hedge funds have a wide suitability. Different hedge funds can have very different risk return dynamics. So you can get very low risk, low return hedge funds, and you can get very high risk, high return hedge funds. And really what drives that risk return dynamic is what net and gross the fund is run at. Now, just to unpack that jargon, when we talk about net exposure, we always use the example that if you give us 100 Rand, we, like any other equity manager, will go and buy 100 Rand of underlying securities where we will benefit from upward moves in share prices. But then we will also couple that with a short book. So let's say we go 50 Rand short. We now are putting on positions that will benefit if markets reduce or those share prices actually go down. The net is the 100 Rand of longs minus the 50 Rand of shorts. It's the net 50 Rand of exposure that we're running at now. The gross exposure that we talk about is the absolute sum of the 100 plus the 50. And that's the 150. And that talks to the amount of bets or positions that we have on in the fund. And as a rule of thumb, the higher the net and the higher the gross of a fund, the higher its return potential, but the higher levels of volatility it'll experience. And the reverse is true. Low nets generally will have lower levels of vol. So if you kind of take that example, we've got a fund which we call our long short fund. That's very much similar to the example that I've just described. We then have a more growth-orientated version of that, which we call our enhanced growth fund. That is more for pre-retirement portfolios. We target an absolute return there of CPI plus 10 after fees, which we've achieved over the life of that fund. And at much lower downside capture than that of the index. We've only captured about just over a third of the downward moves in the market from the inception of that fund. So that's very, very ideal for, those investors that are looking for real return, have a bit of a longer term, a mindset or holding period. And really what you're trying to do is get stronger returns, but differentiated and diverse. The extreme of that then is our market neutral fund. And as that name suggests, it runs with very little net market exposure. The long books and the short books are about equal in size. So there we're not running with very much a market impact. So that will have low correlation to the market. The return will very much come from the spread of how our longs and our shorts have outperformed relative to each other. So, and that's very much ideal for post-retirement portfolios. If you think of living annuities, where you are drawing down on your portfolio, you want real return. So in that fund, we target CPI plus 5. And it's very uncorrelated to other elements in your portfolio. And you're trying to reduce sequencing risk. And by sequencing risk, you mean, you're taking a set amount of funds from your portfolio every month. If you have a steep drawdown, you're actually taking now a higher proportion of that fund out. So if markets turn, you've actually depleted your reserves. So you're really trying to create a smoother return profile. So, hedge funds really are such a wide basket of different strategies. And the beauty of that is that it's widely applicable. But I'll make the point that the diversification benefit that I spoke about earlier actually is prevalent across the hedge fund strategies. They will all have this low correlation to the market, and they will have a diversification benefit.
Yeah, which, I mean, in and of itself makes them compelling. But then when you overlay that with, that granularity on how they work on a gross versus net basis, and how they lean into volatility, because, not all volatility is created equal. Some of it you want to protect against. If you want that smoothing, for example, some of it you want to harvest, all very important points. Historically, though, and if you look at it, Matthew, hedge funds have always evoked images of kind of thick carpeted rooms, old school exclusivity, minimum tickets that could probably buy you a house in Camps Bay. That's obviously changed. How have hedge funds become more democratized for the everyday investor at the moment?
It's a great question, Mark. The uniqueness of the SA market is important to nature. In 2016, hedge funds were brought under the CISCA framework. And by that, we mean they are legislated and regulated like any other unit trust. So if you look at a hedge fund and it has the acronym RIF at the end of it, which is Retail Investor Fund, it very much will look and behave like a typical unit trust in terms of regulation. So it can be listed on a platform, like an Allen Gray or a 91, where you can access it directly. There are, if you will, guardrails around the funds as well. So, I mentioned our gross exposure under the unit trust framework. We capped at 200% in terms of our gross exposure. They are subject to daily liquidity, daily pricing. Underlying securities that we hold are very, very liquid, and the minimum ticket sizes are very much in line with what you will have for other unit trusts. So that legislative move democratized hedge funds in the local market to a very large extent. And you've seen that now play out with greater use of hedge funds by advisors and DFMs, because the ease of investing has substantially increased. So, offshore, I think your point is still valid. It still very much is the purview of institutional investors. This change that we had here has really tilted hedge funds towards the retail market. Fair enough, institutions, I think, are still, they've been a bit slower in adopting hedge funds locally, which is almost in contradiction to what you've seen offshore. But this RIF legislation, I think, has been a bit of a game changer for local access.
And Matthew, we've also seen actively managed ETFs as a bit of a game changer, just in terms of distribution and route to market. Do you think we'll see hedge funds playing in this space in the future as well?
Yeah, I think we will. I mean, this is definitely a developing market in South Africa. So I think you're right. It'll just be another point of access for investors to access a hedge funds. And if you can do an actively managed ETF for a normal unit trust, as I say, we very much look and feel the same. that can definitely be moved over to the hedge fund world. So I think that is going to be a space that's going to develop over the next 18 to 24 months, hopefully.
Yeah, and then again, building on that retail development that we're seeing in the local market. I mean, you see it with the likes of Easy Equities and other platforms. There is a real underlying desire for retail investors who now have access to all of this information. Information has been democratized to go out and, I never encourage doing it entirely by yourself. I think you've got to have a good financial advisor, a good financial plan, adding value, understanding your tax circumstances, all of that kind of thing is important. But I think we have this desire amongst the South African retail investor community to go out and do your own research and to access more sophisticated strategies. And hedge funds certainly fulfill that. And especially at this stage of the cycle, I think they're very exciting. But there are a few hedge fund providers out there. So what would you say differentiates Laurium? I know you've got a very long track record. You're a very well respected brand in the hedge fund space. But what would you say to someone who's watching this if you meet them at the Sunday or Saturday braai, and after the Springboks they say, "What do you do?" And I work for a hedge fund. And they probably start ribbing you about fees or something. But how do you pitch Laurium to that individual?
It's a great question. I mean, so really what it comes down to is team and process. So you mentioned, our longest running hedge fund has been now running for 17 years. So we've seen various market cycles and market regimes. The core team has been together for most of that time period. If you look at our team on average, there's 20 years of investment experience per member. So really we have kind of deep expertise and market knowledge. And I think with a hedge fund, a long track record is really important because you don't have the typical guardrails that you do in the normal unit trust. We do introduce elements like leverage. We absolute return focus. We're free to do what we want in those funds. So really having experienced a manager through how they'd managed risks is a very, very important and critical factor. So it's a track record and consistency of team and process, I think is really important. And then I think we've still got a great balance between being large enough. I always say that we're a big, small manager. And what I mean by that is we've exceptionally well resourced, but our team inherently and our AUM size is nimble enough to deploy quite a very experienced, very deep research process and really to act quickly in the market, to make decisions very, very sharply. We don't get tied up in bureaucracy. We all sit effectively around the same table. And so really it's balancing between, a large team, which is great, but then slows you down, versus retaining an entrepreneurial, very what we call a boutique mindset. And what we mean by that is really, we invested in our funds, we invested in the firm, and sort of we eat our own cooking, and there's an entrepreneurial atmosphere in the office. So these are the key dynamics I think that we offer.
Yeah, and I think that last one is so important. I mean, you've got to be aligned. You've got to have some of your own skin in the game, and that creates a lot of focus and discipline. And I would love to have a fly on the wall insight into your morning investor meeting. So maybe just before we wrap up, you could give us a sense of, what is the dashboard you're watching at the moment? Are there any trends or structural shifts or early signals that you're keeping a particularly close eye on? Obviously, everyone's worried about what might happen next year to the AI trade that we mentioned earlier, and obviously the Fed and debasement and that kind of thing. What's the big trend that you're going to be watching into next year?
So if I was going to sum it up in a word, I mean, the key trend that we're looking at, or the key dynamic, is dislocation. There's been a lot of relationships that you observed in financial markets for a long time that are breaking down a little bit. So I mentioned the gold price earlier. That's been fascinating. You've had the gold prices rally in an environment of decent real yield, which are typically negative for gold prices. So just to explain that, I mean, gold is a currency effectively, but it doesn't yield anything. So that's its downside. The benefit of it is that no central bank can print gold. Okay, so when investors are weighing up whether to hold US dollars or gold, a big factor is what does gold, which is zero yielding, how does that compare to what a dollar yields? Now, real yields in the US are just under 2%. That's pretty much, if you look at the long term, a decent level. But gold prices have rallied, and that relationship with the real yields has broken down. And a lot of that's, this whole idea of the weaponization of the dollar and central banks tilting away from a political point of view away from the dollar. And then, of course, this whole debasement trade. Now, what's fascinating about the debasement trade, if you will, is that the bond market in the US is not factoring any fears of runaway inflation or the dollar having to be printed, because those markets, that the treasury inflation protected market, is behaving. So gold is behaving very differently to the US bond market. One of those has to be wrong. Locally, if you take it down, is an interesting dynamic that we've had really strong bond markets. The bond yield has compressed. I mean, it was above 11% not that long ago. It's now all the way down to about 8.5, 8.6. But what has really lagged that has been local equities. Local equities have not re-rated to the same extent that the bond market would suggest, which does suggest that local markets are actually priced very attractively, especially relative to the risk-free rate. So if you have an element of these interest rate cuts slowly seep into better economic activity, and we can avoid sort of political noise, you could see a nice upgrade in earnings as well as a very supportive ratings environment. So these are the key dynamics that we're looking at the moment. But really, there's a lot of relationships which have which are broken down, which are creating opportunities, risks and opportunities.
Dislocation. I love that. That's going to be my word for 2026. Fascinating, timely conversation. And I think if the last year has taught us anything, it's that markets reward preparedness more than prediction. And I think hedge funds, when well constructed, can offer investors a powerful toolkit for exactly that. So Matthew Pouncett, thank you very much. Co-portfolio manager at Laurium Capital. Great insights. And thank you for giving us a deeper look into how investors can navigate this kind of landscape with clarity and looking for that diversification and the benefits that hedge funds do hold. All the best for the new year.
Thank you, Michael. Same to you.